Silver just crashed nearly 45% from its peak, wiping out billions in market value and shaking investor confidence worldwide. But here's the shocking part. While prices were collapsing, retail investors quietly poured almost $430 million into silver ETFs. That sounds completely backward, right? Most people run when markets crash. But right now, thousands of smaller investors are doing the exact opposite. They are buying aggressively while prices are falling. And that behavior is raising one huge question across financial markets. Are they making a dangerous mistake or spotting an opportunity that bigger players don't want to talk about? Before we go deeper, if you enjoy understanding market psychology and hidden investment trends, make sure you like this video and subscribe to the analysis book. It really helps the channel grow, and it keeps you ahead of financial stories most people notice too late. Also share this video with anyone who follows precious metals or financial markets, because understanding volatility can help investors make smarter decisions during uncertain times. Let's rewind for a moment and understand how dramatic this crash really was. Silver didn't just drift lower slowly, it dropped sharply, creating one of the fastest corrections seen in recent years. Moves like this usually create panic, fear selling, and heavy liquidation across trading platforms. When markets fall that fast, confidence disappears quickly. Traders who bought near the top often rush to exit positions to limit losses. That selling pressure creates a snowball effect where falling prices attract even more sellers. But something unusual happened during this collapse. Instead of retail investors disappearing from the market, they started increasing their exposure through silver exchange-traded funds. That means many smaller investors were buying shares linked to silver prices while volatility remained extremely high. This behavior creates a powerful tension inside the market. Fear usually dominates after major crashes, but strong buying during panic can sometimes signal long-term confidence. That contradiction is exactly why analysts and institutional traders are watching silver closely. Right now, retail investors often get underestimated in financial markets. Large institutions control massive capital, but retail sentiment can still create momentum shifts. When thousands of smaller investors move in the same direction, they can create surprisingly strong demand. Another reason this buying frenzy is attracting attention is timing. Investors are stepping in before clear recovery signals appear. Historically, early buyers during panic phases either capture major opportunities or face extended volatility before markets stabilize. At the analysis book, we focus heavily on these emotional turning points. Markets don't just move because of data, they move because of belief, fear, and confidence cycles that repeat throughout financial history. One explanation behind retail buying is the perception that silver has become undervalued after the crash. When prices fall quickly, many investors believe the asset is trading below its long-term fundamental value. That belief often attracts contrarian buyers who look for recovery potential. Silver also holds a unique position compared to many other assets. It acts as both an investment metal and an industrial resource used in solar panels, electronics, and advanced manufacturing. That dual demand sometimes creates stronger recovery expectations. Another factor influencing retail behavior is inflation concern. Many investors view precious metals as protection against currency weakening. Even during price declines, long-term inflation fears can keep demand alive. Market volatility also plays a psychological role. Sharp price drops often attract attention across financial media and social platforms. Increased attention can lead to increased participation, even if motivations differ between investors. However, experienced traders understand that retail enthusiasm alone doesn't guarantee market recovery. Strong trends require sustained demand, stable support levels, and improving market sentiment over time. The next few weeks will likely reveal whether retail confidence continues growing or fades. What makes the current situation fascinating is a clash between fear-driven price action and confidence-driven investment flows. Silver prices show stress, but investor behavior shows belief. That combination creates one of the most watched setups in the precious metals market right now. In the next part, we'll explore why retail investors are willing to buy during heavy crashes and how their behavior has influenced major market reversals in the past. To really understand why retail investors are stepping in right now, we need to look at how fear and opportunity often overlap in financial markets. Historically, some of the strongest buying periods have appeared when headlines look the worst. Prices fall fast, confidence breaks, and that's exactly when contrarian investors start paying attention. Retail investors today are far more informed than they were a decade ago. Access to charts, data, ETF flows, and global news has changed behavior. When silver crashed nearly 45%, many didn't see it as the end of the story. They saw it as a reset. Another important detail is where this money is flowing. Most of the buying is happening through silver ETFs, not physical bars. That tells us investors are looking for exposure, liquidity, and flexibility rather than long-term storage. ETFs allow fast entry and fast exit, which fits well with volatile conditions. This also suggests that retail investors are not blindly betting on silver forever. They are positioning for a rebound, a volatility spike, or a shift in sentiment. In other words, they are trading the recovery potential, not marrying the asset. At the same time, institutional investors are behaving more cautiously. Large funds tend to wait for confirmation, stability, and reduced volatility before increasing exposure. That gap between retail optimism and institutional hesitation creates an interesting imbalance in the market. We've seen this pattern before in different asset classes. Early retail buying often appears before clear trend reversals, but it also comes with risk. If momentum fails to build, prices can remain under pressure longer than expected. Silver's volatility makes the situation even more intense. Unlike gold, silver tends to move faster in both directions. That means recoveries can be sharp, but declines can be brutal. Retail investors stepping in now are accepting their risk in exchange for potential upside. Another driver behind this behavior is relative value after a 45% drop. Many investors compare silver to other assets that haven't corrected as deeply. When something falls harder than the broader market, it naturally attracts attention from bargain hunters. Social media and online investing communities also play a role. Discussions around buying the dip spread quickly, especially when an asset has a strong historical reputation. Silver has been viewed for decades as a hedge, a safe haven, and a crisis asset. At the analysis book, we often highlight how narratives shape markets. Right now, two narratives are colliding. One says silver is broken, unstable, and too risky. The other says silver is discounted, misunderstood, and preparing for a rebound. Neither narrative has fully won yet. That uncertainty is what keeps volatility elevated and traders engaged. Markets hate clarity gaps, and silver is sitting right in the middle of one. There is also a macroeconomic layer to consider. Interest rate expectations, inflation data, and currency movements all influence silver prices. Retail investors may be positioning ahead of future economic shifts rather than reacting to current price action alone. For many, this is not about timing the exact bottom, it's about building exposure during fear, with the belief that long-term conditions will eventually favor higher prices. Whether that belief proves correct is something only time can reveal. What's clear is that this crash didn't scare everyone away. Instead, it activated a different kind of investor, one who sees volatility as a feature, not a flaw. That mindset is shaping silver's current trading behavior. In the next section, we'll look at what happens if retail buying continues and how that could impact silver prices, sentiment, and broader market psychology moving forward. If institutional investors eventually start following retail momentum, the silver market could experience a dramatic sentiment shift. Institutional participation often brings larger capital flows, which can accelerate price recovery and stabilize long-term trends. That transition is usually slow at first, but once it begins, momentum can build quickly. Another scenario investors are watching closely is supply behavior. When prices fall sharply, mining companies sometimes slow production or delay expansion projects. Reduced supply combined with steady demand can create price support over time. Silver supply is also sensitive to mining costs. If prices remain low for too long, certain mining operations become less profitable. That can reduce new silver entering the market, tightening availability and potentially strengthening prices later. Market psychology is now reaching a critical moment. Investors who bought near the top are feeling fear and uncertainty, while new buyers are feeling excitement about discounted prices. This emotional contrast creates the intense volatility we are seeing today. At the analysis book, we always remind viewers that markets move in cycles driven by human behavior. Fear often appears at the bottom, and excitement often appears near the top. Recognizing those emotional cycles can help investors understand why extreme price movements happen. Retail investors entering after a crash often represent early confidence rebuilding. However, early confidence must eventually be supported by broader economic conditions, industrial demand, and stable liquidity. Without those supports, rallies can struggle to maintain strength. Another interesting development is how silver is being compared to gold during this period. When gold stabilizes faster than silver, investors sometimes rotate money into silver expecting it to catch up. That rotation can create sudden bursts of buying pressure. Silver's smaller market size compared to gold also increases its sensitivity to capital flows. Smaller markets react more aggressively when money enters or leaves. This is one reason silver often shows larger percentage moves than gold. Some traders believe silver's volatility is a warning sign, while others see it as a rare opportunity. Both views can exist at the same time, which keeps market direction uncertain. That uncertainty is exactly what creates both risk and opportunity. Another factor investors cannot ignore is global economic sentiment. If recession fears increase, industrial demand expectations may weaken, but if economic growth stabilizes or accelerates, silver's industrial role could strengthen dramatically. Energy transition trends are also playing a growing role in silver demand. Solar energy production relies heavily on silver components. As renewable energy investment expands, long-term silver demand projections continue gaining attention among analysts. Technology innovation is another hidden driver. Advanced electronics, medical applications, and emerging technologies continue increasing silver usage. These developments rarely impact prices instantly, but can shape long-term market fundamentals. Retail investors watching these trends are often thinking years ahead rather than weeks ahead. That long-term perspective is one reason some investors remain confident. Even after major price crashes, they are focusing on structural demand growth instead of short-term volatility. Still, short-term price behavior remains unpredictable. Market recoveries rarely move in straight lines. Even if silver begins building a recovery trend, pullbacks, corrections, and emotional swings will likely continue along the way for traders. This environment requires patience and strong risk awareness. For long-term investors, it may represent a period of careful observation and gradual positioning. Every investor must decide their own strategy based on risk, tolerance, and financial goals. What makes this moment fascinating is how divided the market remains. Some see silver's 45% crash as a warning sign of deeper weakness. Others see it as one of the most aggressive reset opportunities in recent years. Right now, the battle between fear and opportunity is shaping silver's direction. Retail investors have already made their move by injecting hundreds of millions into silver ETFs. The next chapter depends on whether that confidence spreads or fades. As this story continues, silver will likely remain one of the most closely watched metals in the financial world. Its unique position between industrial demand and safe haven investment makes every market shift more dramatic and unpredictable. If you found this breakdown helpful, make sure to comment below and share your opinion. Do you believe silver's crash is a warning sign, or do you see it as a buying opportunity? Your perspective helps build stronger discussions inside this community. Conversations like these help everyone stay informed and prepared. And if you enjoy deep, easy to understand market storytelling like this, don't forget to stay connected with the analysis book. This channel is focused on breaking down complex financial movements into simple, clear explanations that help you see the bigger picture. Silver's story is far from finished, and the next moves in this market could surprise both skeptics and believers. Until then, stay informed, stay observant, and keep watching how global forces continue shaping the future of precious metals.